everyone, and thank you all for joining. I hope you're all having a good day. So, first, we're going to start usually with talking about the key movers that are affecting the market recently, and then highlight the top economic events, and then go over some of the major charts. So, starting first, I'm going to highlight the movers. Continue. It's been with us for a year now. COVID-19, all the headlines that are related to the virus are still key movers for the market. Especially now, it's even though it's a bit less negative now, but definitely this will have an impact on the market. So when we're talking about vaccinations, more approvals for vaccines, less numbers, as we're seeing, for example, in the United States, the numbers are dropping sharply and almost going back to what they've been in July. This is also positive and it can impact the market. So when we say COVID-19 as a key mover, it doesn't only mean that we're focusing on the negative impact, but also now, since everyone is just waiting for the recovery, so this is crucial to know the track of COVID-19. Inflation. This is what you all have been hearing for a while, and what you will continue to hear about for a while. Why? Because as you can see, most of the commodity prices, they're rising worldwide. What's happening is that most of the investors, most of the institutions, they are just betting on a fast economic recovery. And this was clear with the performance of US stocks, and not only US stocks, it's all the stock markets around the world. They've been so positive, so forward looking, just waiting for all the positivity, waiting for all the recovery to come in place, for economic activity to get back to usual levels. So this definitely inflated the prices of the stocks that we saw. The valuations, they were high for a while, and this is just now moving to commodities. So when we expect a proper recovery, we talk about reflation trade. Reflation trade is when we expect the economy to go back in full capacity, and this definitely means the better services, better manufacturing, and this will in turn just lead to higher prices in commodities, which we are seeing at the moment. So this rise in prices in commodities will also trigger further inflation. So when we say the agriculture they're rising, metals that are used in industries are rising. If we talk about, for example, lumber, which tested record high, and it's crucial for home maintenance and for home sales in the United States. So this is just a small vision on what inflation, how inflation is important, what inflation could mean to investors. So this is how, with the current policies of central banks and even governments, we heard about a lot of fiscal stimulus plans from governments, and now we're waiting for Biden's fiscal stimulus. Also, we're still seeing central banks. They are there for more accommodation, for supporting the markets, for supporting the economic activity to return back on track at any expense, and this was clear from the Federal Reserve Chairman Jerome Powell last week, for example. So this is just putting us in a situation where central banks, with the current policy, they are just adding more money supply to the market, and there are fears of overinflation or rapid inflation, or reaching the stage of hyperinflation, where inflation shoots high in a fast manner, and this will trigger a further action from the central bank to tighten the policy by, for example, raising interest rates or decreasing money supply. And what we are what we are scared of, is if inflation shot higher, unemployment was still high, and the growth was almost null or near zero levels, central banks would be just indecisive. In a way, they have to tackle inflation and fight inflation, but on the other hand, they have to keep an easy monetary policy to just support the job creation and the economic activity. So this could just trigger further problems in the financials, and this is what we have to watch out for also for the long run, as we also are assessing it day by day. Mixed economic data. Last week we had a series of economic indicators from Eurozone, United Kingdom, the United States. So we saw a little bit of a mix between performance. For example, the manufacturing PMI, it was stronger in some areas, where services PMI was weaker. Also, we saw the United States retail sales, for example, jumping 6%, the highest since long time, and this is just a strong reading. While the December retail sales figures in the United Kingdom, they were sharply lower. Also, from the keeping with the United States, we can just also highlight what have been happening with jobless claims. For example, they are failing to, they're always near 800,000, and this is just alarming, always alarming for investors, and signaling that the labor market is still weak. So this is what we mean by mixed economic data. So the US economy is showing some strong signs from a point of view, but also unemployment and the labor market is still a little bit weak. The Fed meeting minutes also reiterated that the Federal Reserve would remain supportive to the current policy in order to just boost the economic activity and the economic recovery. So nothing new was there from the Federal Reserve. Also, the ECB monetary policy minutes, they also showed the same. All central banks around the world, they're just keeping to their policy at the moment. As long as there is no real threat they can see for the moment from inflation, they believe the current policy is appropriate. Now let's move to highlight the top economic indicators to be released this week. So starting with tomorrow with the average earnings index and bonus figures from the United Kingdom for December, along with the unemployment rate, sharp rise in average earnings. This is what you have to watch out for. When earnings are rising, this will definitely put some pressure on the future on inflation. So as long as we see higher numbers, we could expect inflation expectations to go higher. Unemployment rate is expected to rise higher towards 5.1 from 5%. Claimant count for January to rise 35,000 versus 7,000 in December. Moving to the Eurozone, we have the consumer price index month-on-month, also expectations of a rise by 0.2%. Moving to the US, CB consumer confidence to tick slightly higher towards 90 from 89.3. The Federal Reserve Chairman Jerome Powell will be testifying. It's one of the top events for the week. Any highlights from the Fed's chairman on the recent rise or the recent rally in Treasury yields? Any intentions from the Federal Reserve or any highlights on intentions from the Federal Reserve to cap this rally in Treasury yields will definitely have a clear impact on the market. As long as Treasury yields are on the rise, we're still in the same reflation trade. If the Federal Reserve will intervene to cap this rally in Treasury yields, this will definitely lead to a much weaker dollar in the market. And then we end the day with the API weekly crude oil stock. On Wednesday, we start with the early from New Zealand with the Reserve Bank of New Zealand interest rate decision. Nothing of a change is expected on interest rate. However, the bank will definitely stick to its asset purchases program and just highlight its or express its readiness also to support the economic activity and the economic recovery. From the Eurozone, we have the German GDP quarter on quarter, the second reading for the fourth quarter GDP from Germany, expected to show a slight growth by 0.1%. Moving to the United States, US new home sales expected to rise 855,000 in January. Home-to-home market or the housing market in the United States is showing a strong signs, and this is just obvious with most of the indicators related to the housing market. Crude oil inventories are expected also to drop again by 2.429 million barrels. Thursday, we start with the German GfK consumer climate expected to improve towards 14.3 and negative 14.3 from negative 15.6. Also, consumer confidence from the Eurozone is expected to remain near 14.8. I can see some questions. Usually we keep the questions to the end. So when we finish everything, we have a Q&A session so we can answer all the questions. Moving to the United States, we have the durable goods orders for January, expectations of a growth or expansion by 0.7%. The GDP, the second reading of the fourth quarter GDP from the United States, expected to show a growth of 4.1% versus the prior reading of 4% in the fourth quarter. So as long as we have an upbeat reading, this could just be positive for risk-on sentiment. US initial jobs claims to show a rise by 843,000. Also, the pending home sales to show a slight decline by 0.1%. On Friday, we have the Pce Price Index. Pce is one of the key or favorite gauges of for inflation for the Federal Reserve. So definitely we have to keep track. Any positive surprise or up surprise in the core Pce Price Index month-to-month change could just be alarming on inflation for the future. Personal income expected to show a sharp increase by 9.9% in January, pushing in consumer sentiment to slightly rise to 76.5 from 76.2. And we end the week with the US Baker Hughes oil recount, which extended their upside rally towards 306. This could just give us a slight hint on the production in the United States, how it's gonna have a better pace. This recount dropped to 181 during COVID, and now we're almost near 306. As oil prices are getting higher, producers are excited to get back into production. Now let's move to the MetaTrader 4 platform to highlight some of the key price patterns that are being formed. So let's start first with the euro dollar on the weekly chart. You can see that last week the market had a short decline and then failed to close on a significant direction, but closed almost neutral. If we move to the daily chart, you can see there is a possible inverted head and shoulder pattern that everyone in the market is talking about, with this inverted head and shoulder, with this being the neckline. So it's very clear what's happening. Also on the dollar index, you can see it's very it's the opposite to this reading. However, this could just be it's a significant trade, it's a significant pattern. However, you have to stay precautious, since most of the times when these patterns are just so clear, we have a couple of false breakouts until they happen. So this is a possible formation that's currently in the market. Also, to just add for what we are seeing, this channel is still holding for the euro dollar, and the bottom is almost there. So we're still trading almost in this channel, and you can see how the head and shoulder is formed. Inverted head and shoulder is formed at the bottom of this channel, with the target being the previous top, maybe even higher to the top of the channel. However, this is just important to assess what's happening in the market on the fundamentals, especially if the Federal Reserve will continue to just watch yields going higher, and this could just add some strength to the dollar. We could be seeing this pattern reversing again and just trading sideways and maybe slightly lower. However, on a softer dollar, on any intervention from the Federal Reserve to cap treasury yields rally, this could just lead to further upside in the euro dollar. So key levels just to highlight, you can watch out for the previous top of almost 120, 170, 120, 180 is just the key area. Breaking above it and closing above it, it's just bullish. We have to look again towards 2275 and the previous top of 2350, while any move back lower below 2040 would just be bearish again, and we could be retesting the previous bottom of almost 1950 on the euro dollar. So these are the possible levels if you are trading the euro dollar. Moving to the British pound against the United States dollar. So you can start with the weekly chart that we are seeing currently, and you can see a series of consecutive weeks to the upside, and this just have a couple of reasons. Among them, the rise in inflation in the United Kingdom. The other key reason is just optimism over the path of the United Kingdom and just providing vaccination, which could just support the country in coming back to full economic mode and faster than other rivals. So you can just draw this trend line combining these bottoms. As long as we're above this trend line, we're just aiming for a more bullish move. You can just go for a parallel line to just try to set maybe a possible target to the upside, which could be 43.40, which is the previous also top. You can see this double top here that took place in 2018. Also, this could be just a possible target on the long run for the British pound against the United States dollar. If we go to the daily chart here, you can see how the market is just also moving quickly higher. We have another channel that could be taken. This place can be drawn that way. You can see how the market 1, 2, 3, 4, 5, and we're currently holding near the top of the market. And if you can go also clearer to the hourly chart, you can just highlight another steep channel. So this is how we are trading and for the pound against the United States dollar. So watch out for these reversals. All the dips were both on the pound, so the buying dip was very clear. As long as we were just holding above 37.70, I believe the market could be just bullish and we could continue to the upside. Now we're almost 250 pips away. However, this is the key support if the market goes to a bigger correction. You can see how the market is just drawing the tops and bottoms. So you can just highlight these waves. So you can see the market is moving higher, having a corrective wave, moving higher, then another corrective wave, and then moving higher. So just if you want to trade a British pound, just go for usual trend trading. These are the reversals. A break below the previous bottom could just turn bearish again, and we could be heading for a bigger correction. In order to just set some levels, just first support zone coming at 39.53, and then 38.30 and 37.60. These are the key levels on the downside, while on the upside 41.20. For 41.20 is just a possible key level to the upside. You can just go to previous charts to just highlight the possible resistance zones. So these could be the possible resistance zones: 41.20, 42.40, and 43.50 for the British pound against the United States dollar. Moving to the US dollar against the Japanese yen, the dollar was still strengthening a little bit. So when we had this breakout is still clear and still valid. We had a bullish engulfing, almost a bullish engulfing candle last week. However, we closed off the highs. If you go to the daily chart, you can see a series of uptrend. You can just draw a trend line combining these lines. You can just go for a projection. This trend line, just have a parallel line, and you can see that we are trading clearly inside this channel. So watch out for any break back below 104 for a change in trend, 104.44 change in the current trend, while moving back above 105.80 could just turn bullish again, and we could be heading towards 107 on the dollar against the Japanese yen. The dollar against the Swiss franc, also similar formation to what we had previously with the euro dollar, what we were just suggesting. This is the possible trend line that's been holding for a while. So you can see how the market was traded. We had this inverted head and shoulder formation, and then the market moved higher, back to the neckline, and then moved higher again. So now what's crucial or critical is just breaking above this key area here, which is just highlighted. So we need to definitely break above this area, above 90.70, in order for a clearer action for a bigger move higher towards 92, 93, which are the key levels that we were trading at for a while previously. So these could be the possible levels if you are trading the dollar against the Swiss franc. I'm just going to highlight them now after I showed you your the possible scenario. So definitely we need to clear up at this point. This is the possible target, 91.80, 92. This is the extended target. So these are the possible targets on the upside, while moving back below 89.20 or even 88.70 on the bigger picture. You could just turn bearish again. The Australian dollar against the United States dollar, it's still on the upside, among the strongest among all. You can just draw this trend line combining these previous bottoms, where the market is just moving higher, having a correction, moving higher, having a correction. So as long as we're above the previous top of 78.13, we could just be heading towards the 80 level again. The New Zealand dollar, also similar formation. You can just draw this trend line. It's still holding. We're still trading in the same trend, in the same direction. So following this sideways trading last week that took place last week, we had a clear break from 72.50 in order to move higher. As long as we're above 72.50, we're poised towards 75 level. Moving back below this trend line, combining these previous bottom, could just turn bearish again. What you can do in terms of projections, you can just draw a possible channel having these points and just draw a parallel projection and just try to assume where the market could be going. Towards 74.40 could be the first resistance ahead of 75. The US dollar against the Canadian dollar is still the bigger formation, is still formed, still valid. So we have this formation where the market projected to the downside. And you can also draw these bottoms by combine these bottoms in order to have a possible target to the downside for this pair. So you can see how we're still trading in it. I still prefer just waiting for a clear breakout out of this zone, or at least if you just want to go to the closer time frames or smaller time frames, if you're just bullish on the dollar, you need definitely to watch out for any break above this trend line, or at least clearing back above 27 could just be bullish again. As we are, we could be heading towards further weakness on the pair towards 24.80. 25, as long as also the gold oil is just benefiting. This is for gold, which fell towards 1760 last week. So you can see how the market is just still moving. This was the bearish drop last week in gold, and how the market rebounded significantly from 1760, the previous top exactly, the previous bottom exactly. So now we're just still inside this bigger range, 1960, 1760, $200 range that we're currently trading in. And this is definitely going to depend on how the Federal Reserve will tackle inflation expectations and the rise in treasury yields. So this is just a key highlight that everyone is waiting for from the Federal Reserve, and will definitely impact everything. So what's just supportive a little bit for gold is just rising inflation expectations, along with yields not keeping up with inflation, could just be bullish for gold. And definitely we need to watch out for, as I said, how the Fed will deal with the current or with the rising treasury yields. This is the formation that we're currently having on gold. So breaking back above 1815 could just lead us higher again towards 1874. Silver price is almost similar formation. However, so silver was a bit more solid. So we need to definitely break above 27.80 in order to just retest the 30 again, while moving back below 26 could just turn bearish, and we could be falling again towards 24.10 on silver. These are the possible scenarios. You can see how the market has been consolidating in this range for a while, between 26 and 28, awaiting for key drivers for a break. Moving to WTI, oil still on the upside, still continuing to the upside. What we could be just heading for on WTI, you can just go back to the charts. You can see how the market here had a clear two tops. So this could be the possible target ahead of a correction for oil prices. If we go to the daily chart, also you can just draw this channel by combining these bottoms and tops, and you can see how the market 1, 2, 3, 4, 5, and 6 exactly at the top, and then the market moved lower, trading sideways. You can just add the moving average exponential 21 for having a better assessment for how the market is moving. So you can just go for. You can see how the market was just responding with the 21-day moving average. Each drop towards the 21-day was just bought. So watch out for any dip back below 21 again, or towards a bigger correction. So what could be a key support now, or a key base again for oil prices, $54 is just the coming key base. We're on the upside, definitely what we highlighted with the trend line and the previous top of 62 almost. This is a possible scenario for oil. Moving to the Dow Jones, which was weaker on the day, definitely moving back below this area here, or closing below this area here, could just be bearish again for the Dow Jones, and we could be heading towards 30,600 as a first target, and then 29,650. These are the possible targets. You can see how the market is moving. What's pressuring stocks is the rise in treasury yields. So also, as I said, if treasury yields will continue to the upside, this will add more pressure on stocks. Else, we could be just poised to further inclination. We're still in the same range for the Dow Jones. We're still in the same channel, trading 1, 2, 3, 4, and we're almost trading here near the tights. So you can just draw these lines here, combining these previous tops. And if you want to go closer or zoom in, these are the possible levels. Watch how the market was also reacting to the 21-day. Drop below 21-day was just bought, and the market moved to the upside, unless here This is an exception, so you can see how many times here the market bounced off the 21-day and even here. So watch out for a clear break with the heavy volume and the drop towards 30,600. These are the possible levels for the Dow Jones. And this is all for today's session. If you have any questions, please write them down. I'd just like to remind you that all the information, news, analysis, and opinions mentioned in this session, they're only for educational purposes and shouldn't be taken as a signal whether to buy or to sell any financial instrument, and ICM doesn't provide any investment advice. If you have any questions, please write them down. Perfect. I believe this is it for today. Thank you all for joining, and I wish you a successful trading week.